So, why do systemic asset managers hire economists? For more on this, we're delighted to welcome Adam Reg, Capital Fund Management, and David Thesmer, the Franco Modigliani Professor of Financial Economics at the MIT Sloan School of Management, and also Research Associate at the National Bureau of Economic Research. Our first speaker, Adam Reg, is Executive Director at Capital Fund Management, a global asset management company based in Paris with offices in New York City, London, Tokyo, and Sydney. CFM manages a large set of quantitative strategies which trade liquid instruments across global markets, including futures, equities, bonds, options, foreign exchange, and various derivatives. Dr. Reg joined CFM in 2014 and focuses on systemic global macro research. He completed his PhD at Max Planck Institute for Gravitational Physics in Potsdam and held a postdoctoral position at Imperial College London and also at the Institute for Advanced Study in Princeton. Adam, thank you so much for being with us.
Hi.
One of the biggest questions for wealthy investors and fund managers attending the World Economic Forum at Davos this year was, where do we put our money? Now, we invite you here today to talk not so much about how to invest, though that information may be helpful for some, but rather to explore how economists can help investors to answer this question. Can we begin by talking a little bit about the skills economists apply to systematic asset managers, the types of questions economists are currently working on, and the areas of research that have emerged in relation to this problem?
Sure. So let me start sharing. Can you now see my slides?
Yes, it's perfect.
Great. Well, hello, everyone. David and I are very happy to be here with you today and to share some insights into why do systematic asset managers need PhD economists. As you already know, David is an economist and I'm an investment strategist working for CFM, Capital Fund Management, a quantitative asset manager and a hedge fund. So I prepared a couple of slides to help to kick off the Q&A session. So let's get started. So asset managers engage in trading and investing, and the distinction between the two is somewhat blurry. I think one thing that people would agree upon is that trading is faster and investing happens at shorter timescales. Among asset managers, there is a subgroup, the hedge funds, that typically engage more in trading than investing. Because of regulations, hedge funds have more appetite for risk and they're more keen to leverage up, to put on short positions, to enter more exotic derivative contracts or to expose themselves to risky market directions. Now, there are different investment approaches, and the classic one is the discretionary one, where the funds, the portfolio's positioning follows the portfolio manager's perceived value and opportunity. And it is, of course, informed by in-depth market research. On the other side, there's the quantitative approach, which relies on number and data crunching. So you essentially go through data sets and you look for patterns in data with the expectations, with the hope that these patterns will repeat themselves in the future. And then there is a quantitative approach, which tries to blend the two. Now, the trading and investing may happen at different happens at different timescales, and different timescales require different skill sets. So on one side of the spectrum, we have high frequency traders, where the holding periods range anywhere from milliseconds to hours. And this type of short-term trading requires ultra-fast execution advantage. People study the order book dynamics, etc. So this short-term trading, this activity typically attracts people with more technical skills. And then there is the midterm trading and investing, daily to monthly holding periods. And this is where I would say the most of quant and non-quant hedge funds belong to. There's a plethora of strategies that that people follow that fall into this within that holding period bucket, ranging from arbitrage strategies, behavioral effects, corporate actions, global macro. And then finally, there's the long-term investing with holding periods from months to years. This is really more investing than trading. And again, there's a range of strategies that people employ at those timescales, like value investing or harvesting risk premia or slow trend following. So where do economists fit in? So I think it should be clear that it's the midterm to long-term categories that economists are better suited to. Oh, sorry. So what value do economists add? So PhD economists have in-depth knowledge of the most recent research in their research area, but are also aware of how the field evolved and the history of the history of the ideas in the field. And they also they stay abreast of the ideas floated in academia in related fields of research, and that's very precious. Economists are they have very good data analytics skills. They are experienced in handling new data sets, and they are well aware of pitfalls and caveats that may come with those data sets, like look ahead bias or point in timeness. They're very well versed in statistics and statistical modeling, and in particular, they have experience in modeling economic variables. So they're aware how people typically think about different economic variables and about modeling those. Okay. The investment approach determines the job profile. So at quant shops, economists, they typically disseminate the newest newest research in economics and finance, and they help the investment team to turn that into algorithms or to monetize the newest research. They help the investment team to interpret the backtest. A strategy may overall work well, but it might be periods when it doesn't work so well. So the economists can help the team to understand, to employ their economic knowledge to help to understand why this is the case. And they also help the team to avoid overfitting by using their intuition or proposing robustness tests. And then for discretionary asset managers, the job profile is slightly different. So economists typically stay abreast of the newest macro news and macro releases and forecasts. They might develop models of their own to forecast different economic variables. They articulate the logic and discuss the logic behind different investment strategies with portfolio managers, but also with clients. There's some client-facing roles too. So I hope I've already driven the message home that economists they can contribute to asset management quite a lot and on many different levels. However, obviously the role the investment world is different than academia. So some questions that are of academic interest are might be of little practical relevance for practitioners. And sometimes there's really no time to dig deeply, and decisions need to be taken fast. It's a very useful skill to have to be able to explain complex phenomena with simple toy models or scenarios and assigning probabilities to those scenarios, etc. Now, any pattern in the market is a net effect of multiple forces, and as an economist, you might easily identify some of those, and you might be aware of some of those, but sometimes, the market surprise people, and there might be forces at work that you didn't expect there to be there, and so it's important to keep an open mind and be on the lookout for the unknown, and then the behavioral patterns may be confusing. What I mean by behavioral patterns, I mean how market participants behave. So it's okay to have a prior. It's okay to think the market will do this. The market should do this, but you need to be ready to let go of this prior if the market proves you wrong. So flexibility and pragmatism is critical. And I think I will stop here.
Thanks so much, Adam. That was very, very insightful. Our second speaker is David Thesmer, the Franco Magdigliani Professor of Financial Economics at MIT Sloan School of Management and Research Associate at MBER. Professor Thesmer's research has been published widely in leading academic journals and focuses on behavioral economics, corporate finance, and asset management. He's currently a senior research advisor at Capital Fund Management. Professor Thesmer, thank you so much for being with us today. Now, in the wake of the COVID-19 pandemic, the financial and legal system will need a great deal of help in terms of moving beyond the financial distress in the business sector. Some firms, as you wrote in your recent paper, Sizing Up Corporate Restructuring in the COVID Crisis, will be able to survive, while others will face bankruptcy and thus need to be liquidated or reorganized. I wonder what the role of economists will likely be in the surviving firms that will need to be downsized or acquired. How can we tell objectively whether those managers or asset managers are doing a good job, and what will be the role of economists in this space?
It's a broader question. So essentially, there is so we have worked together on the slides that Adam presented, and I think we share kind of the same views on this. I mean, it's kind of Adam presented, but it was really a co-production. I don't know that I'm I'm very happy to discuss, everything that's kind of being an economist in an asset manager, in a quantitative asset manager, because this is what I do with Adam and his team. I'm happy to discuss restructuring of US corporations and European corporations for that matter, but it looks a little bit different from from the core topic of this class. So maybe if students, what I suggest is this. So maybe if students are asking questions about the opportunities for economists in restructuring, which I don't see that there are many, I think. But perhaps in asset management somehow. And if students are asking questions, maybe I can jump and and answer some of those questions. But otherwise, I think I would prefer to leave the floor to students and to questions. I think that would be the right way to do it.
That sounds good. So we'll certainly open the floor up to questions. Students, you can certainly unmute yourselves, or you can type your question in the chat box.
Yeah, I can answer questions on the chat box too. Adam or I actually can be questions to Adam. To be honest, I mean he's the guy in charge. Yeah, so please go ahead.
So I don't hear any questions. Sorry, Adam.
Yeah, I wanted to say that while we're waiting for the questions to come in, I want to say that we collaborate with David a lot on a wide range of projects, and it's so that just to give you a sense of the day-to-day work. So like recently, well, I cannot share obviously the details because of confidentiality, but I have came up with a strategy that I found a bit unorthodox, and we spent a lot of time discussing it with David, and approaching it from different angles. And David's help was really useful, so that I could validate that what I was working on is which, as I said, was pretty much unorthodox, that it kind of makes sense. So in general, I feel that economists play a very useful role at in asset management, and yeah, I mean it's a great career opportunity.
Sure.
Yeah, perhaps, yeah, I can. But please do ask questions, students, because this is why this. I mean, this is supposed to be like so it can be very good. I see a question. Okay, what specific skills are useful that economists use in asset management? Is there a more of a focus on programming, on the financial intuition? So I would say it's the ability to do both as an economist. So it's kind of economists are able to understand and manipulate data, and that's certainly a skill that would be needed in quantitative asset management, at least. So the ability, I mean, the practice of manipulating data, sometimes new data sets, understanding outliers, being able to run simple statistical analysis, being able to attack the data set by asking like specific questions, etc. All these are qualities that physicists like Adam actually have, because they know how to do this with a lot of common sense. And economists also do. What they bring into the table is their knowledge of the economics literature, so their ability to basically ask questions that make sense from a viewpoint of economics. So it requires a training that economics PhD typically have. So it's both the programming and the financial intuition. It's really the ability of having both, at the same time, in the same brain, in a sense. So yes, yeah. So it's both, really. It's really important to have both. I think what we do also, so it depends on the firm. So what we do is Adam, and also with the folks in Paris, is also like more. So not all firms are like this, but CFM is certainly a firm like this, where there is some value that is put on actual research, and so an actual not research, not R&D, but really like more like academic research, where we ask kind of broader questions like, is there such a thing as factor momentum, or are analyst forecast overreacting or underreacting, or things like this that are more that have clear spillovers onto the production of actual trading strategies, but at the same time that are like at a broader level that can be formulated as academic questions. And producing that kind of research is part of CFM's output, like in several other firms. For instance, one famous one is AQR, but there are others, where basically management tends to think that it's useful to kind of try to think in an academic way, because it's going to spill over into actual strategies. And so basically that's what we collaborate on with Adam. We have those various projects that we're working on, from trying to think about overfitting, or analysis of stock momentum, or trying to think about the interaction between macro and micro forecasts, for instance, which is, I mean, we have two goals at the same time. One goal is to produce, signals and, quantitative strategies. And the other goal is to try to think at a higher level and produce, a product that would be sold, quote unquote, to the academic community. And that's also a lot of our interactions.
Awesome. Thank you so much.
Thank
Aditi,
you
yeah.
for that question, Aditi.
Oh, yeah.
We have a couple of students from the Data Science Institute wondering about machine learning and what this will mean for asset managers and economists.
Yeah, it's a good question. So Adam will have things to say. So my So machine learning is important. It's kind of part of the standard toolkit now of young economists. I think if you're still doing your PhD, I mean, you should take a machine learning class just to know a little bit about those techniques and how to manipulate them. Then, of course, machine learning is about predicting much more than anything else, and economists are typically interested in, causality, etc. So when you do economic research, machine learning is useful because, in a sense, it's important. I mean, it's sometimes useful to predict stuff, in particular to build instruments, for instance. But in general, for causal analysis, it's not really machine learning that you need. In asset management, however, I've seen the field change over the past decade or so. So I would say a decade ago, machine learning people would be frowned upon in a sense in asset management by saying, people would say, oh, but the world of finance is very complicated. If we just throw a bunch of variables at a problem and let the machine look for it, we're not going to find much because there's so much noise. It's already, I mean, you need a very strong economic prior for each signal. Now it seems that in fact machine learning are working a little bit better. Machine learning techniques are working a little bit better at predicting returns, and I think that has spilled over onto financial economics, like even to predict profits, to predict those. I mean, there have been like a bunch of recent papers on that topic. It looks like machine learning techniques are able to find nonlinearity that seem to be relevant. And that, as economists, we don't understand. So then there's going to be a back and forth. So it's going to be like the prediction work is gonna come back to trying to change our way of thinking about true economic mechanisms. I think everything that's related also to text analysis is important in a way that we don't fully understand, but the way information is processed on financial markets, for instance. Is definitely going to be some of those questions have to be addressed by machine learning techniques, for instance.
So maybe on my side, I'd like to add that it's in the nature of the financial data that there's a lot of noise and not that much signal. So one has to be careful when employing machine learning techniques. Because, well, it's easy to find spurious relationships in the data. But, having said that, careful application of machine learning techniques can be very useful and actually can help reveal some previously unknown relationships between economic variables. So machine learning has become widely used on the quant side of asset management those days. But as I said, you have to exercise caution and also always try to find a intuitive explanation for what you're seeing.
Excellent. We do have a couple of questions coming in. The first question, aside from COVID, how will the 2020 election affect the work of asset managers / hedge funds in the coming months and years?
That's a hard one to predict how the market is going to be. I don't think it will affect the job of asset managers in any way, actually, The election or COVID? So that was a bit of a complicated. I can see that's a question I cannot see on the
right.
chat,
It came to me privately. It said, aside from COVID, how will the 2020 election affect the work of asset managers and hedge funds in the coming months?
I don't think it will. I don't think it will.
Adam,
you're muted. Yeah.
Yes, I'm muted now. Well, we're waiting for, we're so far, the markets were, I'd say, relatively quiet, and we're waiting what's going to happen next. That's all I want to say on this subject.
Good. Another question then, discretionary managers seem to be able to move forward looking while quant managers seem more backward looking. Can you give specific examples of where macro variables can be used by quant to position and portfolio in evolving environments like we're seeing today?
Macro variable. Okay, David, you go ahead.
Go ahead, Adam. Go
no,
ahead.
I just wanted to jump in that, you know, it is true that quants are more backward-looking, and while discretionary managers are more forward-looking. However, you know, quants are in the business of forecasting. It's just that they look more backwards to, you know, make predictions. So, you know, that has advantages and disadvantages. And the disadvantage is that, you know, indeed, you might be missing something that is brewing, right? On the other hand, the advantage is that you stick to, you know, you stick to certain trading rules, and you're very consistent. And sometimes, you know, when the fundamentals say buy, and you know, a discretionary manager may hesitate because of the current market condition, but you know, your algo will tell you buy, and you know, this consistency, you know, may, you know, actually may be very beneficial because it takes out the human factor from decision making. You know, those decisions are taken by computers, and so there are less emotions in the game. David?
Yeah, no. That's what I wanted to say. I think what I can add is that there is, there is though a human factor in there, which is, and that's interesting because it's an internal question that keeps coming back, which is the decision to put a machine in place and the decision to unplug a machine is always there's always a human, even if the machine is trading, you know, there's always a human that decides to, you know, switch it on or, you know, or off, or to allocate the machine more money or less money. And there are lots of various philosophies among quants. Some quants say, okay, I would want to unplug the machines as soon as they stop working. Some other quants are more relaxed and they say, okay, you know, that's precisely what's great about quantitative investment, is that, you know, you have to let the machine in place. And so there's always, you know, the tension between under and overreacting to news that's even there, even in quantitative. So what I mean is subjective judgment, human judgment is still there, even if you're making quantitative investments, I think.
So in a sense, you know, that's the third approach that I briefly mentioned in my slides, the quantum tool, where you essentially use quantitative methods to, to back up your investment decisions, but you let yourself the liberty, the freedom to override what the machines are telling you, and, you know, use a bit of, you know, gut feeling about what the market's going to do in the near future. So,
but
yes,
even if you are,
yes, David, go ahead.
Yeah, even if you're a hardcore quantitative person, I mean, you won't let your machine run, you know, with a fixed dollar volatility forever. You know, at some point you will. Sure. But it's true. But quantamental has the subjective layer. I mean, so for instance, some stuff I'm working on these days, like about predicting profits. So it's not with CFM. So I am at liberty to talk about it. But so if you're trying to predict profits of firms, you can use lots of, machine learning techniques to try to use as many variables as you can to basically predict profits. But you can combine those objective variables with subjective variables, which is like analyst forecast. And basically, of course, you're improving on the analyst by using the machine, and you're improving on the machine by using analyst. There's some kind of complementarity that comes from the fact that, very simply, analysts are biased, they can be noisy in their expectations, but at the same time, you know, they have some access to some information that the machine doesn't. And so basically combining the two, and that's kind of where the quantamental is going, combining the two is kind of where probably lots of the value added, even in quantitative asset management, can be, yes. But you have to do it in a disciplined way. So that's what is tricky.
You know, maybe I can chip in a little bit. You know, some investors, they really, with quantitative methods, you develop your models, and you have, fixed trading rules, and you really, of course, that is important to know, like to expect which way the market will be going. But that's not how we make investment decisions, because the investment decisions are based on the back-tested investment strategies that you have put in production. And the clients sometimes they they like to ask those questions. So where do you think the market's going next? And you know, those type of questions, they're, I guess, in a way more easily answered by the discretionary managers, which really focus on what they think the market will be doing next, rather than the quants, which more, you know, as I said, they stick with a very fixed trading rules that have been backtested for decades, and in some cases, and yeah, it's follow an algorithm.
Thank you. Next question, do economists at CFM have internal models that are definitely publishable in top journals like Econometrica or JPE, but are too useful to be made public?
That's interesting. So I don't, so that's an interesting one. So the short answer is no, I think. So the longer answer is sometimes, you know, in particular in execution, you have complicated models to basically, you know, deal with the high frequency regularities of markets. And there it's more like engineers, you know, so it's machines that are complicated, and some of them can get published in financial engineering journals or even in finance journals. But what folks are interested in at Econometrica or JP would be more like, you know, is it the case that, I mean, it's more broader economic questions that, you know, asset managers are not so much interested in, like, you know, is authority good in organizations, or is it a good idea to pay a policeman based on the number of criminals that they arrest, or, you know, so it's much broader than, you know, what people do in the industry. So I don't think, I mean, I've never met any model that was publishable in a top, you know, econ journal, but I've met people using models that could be published in finance journals, like more applied in a sense. But even there are not that many. I've seen, however, a lot of research, applied research, such as the one that we conduct with Adam, that is published in top finance journals. Even, I mean, Jean-Philippe Bouchot and I have a paper on this too, in the Journal of Finance. But they're more like, you know, they're not about what specifically CFM does on a day-to-day basis. They're more about, you know, broader principles, you know, that are of interest to. It's not the same product in a sense. That's the way you have to think about it. Like when you produce research that's relevant to generate alpha and, you know, profits for investors, it's not the same product as something that is interesting for academics who are interested in broad mechanisms, stuff that they can teach in the classroom, etc., etc. It's not the same product, so that's why it's a hard question to. I mean, it's impossible to say yes to that question.
So if I may jump in for a second, so you know, I wanted to add that actually, you know, CFM is one of the few asset managers that publishes a lot of research. So, you know, if I'm permitted to advertise a bit, you can go to www.cfm.fr and you can find a lot of academic publications there. And of course, there is part, you know, of the findings, part of the research we publish, but there is the more confidential part that we keep to ourselves. I mean, in the end, we are in the business of, you know, delivering returns to our investors.
Thank you.
Yeah.
Second question.
But yeah, go ahead.
No, go ahead, David.
Yeah, so it's published in good academic outlets, but the top econ outlets that that Sergey was mentioning are actually. Okay, there used to be, back in the 70s, it used to be that financial engineering was really part of economics. So it was Merton, Black and Scholes, etc. So during those days, you could publish in those top outlets financial engineering papers. Nowadays, less so, I would say. So that's the thing. That's because financial engineering is not considered as part of economics anymore. Well, it used to be in the 70s for some reason.
Absolutely.
But still, I mean, it doesn't mean it's not interesting. It's very applied, that's all. Yeah?
Exactly. The research, you know, we're mostly focused on is the applied research.
Yeah. But it's, it's very, so, okay, so there, there seems to be an implicit ranking also of what is interesting and what is not. I think asset management and quantitative asset management is probably a segment of the professional world where people who have an intellectual bent are actually going to be the happiest, I think, because this is, people are really true intellectuals there. They're really in to make money for the investors, of course, but they like to spend time thinking about new problems in a systematic way, etc. So that's kind of it's very nice work environment to be in. I have to say, each time I go to CFM's offices, which I'm not allowed to do anymore since the recent development in the health world. But it's always a huge boost to actually even to creativity, but also to actually, it's very nice to discuss, all these new ideas that are out there. And sometimes it gives rise to papers, but in a way that is a bit independent from actually producing, CFM relevant research. Okay, sorry, Sophia, you can go ahead.
That's okay. No, this is helpful. This is really good. It's really good to sort of have you, your undivided attention for our students. So we're really happy with you expanding upon these points. We have a question from Tess Shi. Discretionary managers seem to be able to be more forward-looking. Okay, so I think that we've already answered.
You had one.
Right.
But there's another one.
Aditi, yeah, Aditi has another question. Do you have any recommendations on literature or books for those who are early in their career and considering a future in asset management? I think this is really about how do you figure out how to turn poorly performing businesses into star companies, maybe something that can guide them in terms of just some general reading.
David is a university professor, so I'll let him take this one.
Yeah, can you repeat that one, Sophia? Sorry, I was...
Yeah, that's okay. So do you have any recommendations on literature or books for those who are early in their career and considering this pathway?
Of working in quantitative asset management.
Asset management, correct.
Yeah, so that's so it's a good question. So I think I would read, in fact, just to have a sense of what it is to work there. I would read the popular books, I think, that are like good reporting of how it works in there. Michael Lewis, for instance. So there are a few Michael Lewis books that are on quantitative investing. I think I would read also another book that's on the failure of LTCM. So when genius failed, I think that's called. So that's the story of the LTCM crowd and how it failed. But he was an early quantitative investor. So that's what I would read, just to get a feel of what it is to be like on a day-to-day basis working for these companies. Then afterwards, in terms of articles and papers, I would read what CFM produces, what AQR produces also. AQR is producing a lot of papers also that are like easy reads for academics because they are kind of written by academics very often. So CFM is more like it's more physicists turned into finance. AQR, it's more like financial economists like myself. Just to have a feel of the kind of questions they're asking themselves. You can read also what I like also is the blog of Cliff Asness. So Cliff Asness used to have a blog where he's written like a lot about his, so his company has not been doing that well over the past few years or past year, let's say. And he's been in a very candid way. He's asking himself like a lot of questions about, what it is to be a quant, why should I unplug, the unplugging questions I was talking about. Emmanuel Derman also, who is a professor at Columbia, I think, financial engineering professor at Columbia, and a historic quant also, has a book which I've never read, which is called My Life as a Quant. That I think would provide you with a good view of what it is to be there. So yeah, so in terms of current research, I think AQR and CFM would give you a good sense of what kind of research people and what kind of topics people are thinking about. So in a fairly structured way, kind of in a fairly deep way, and the popular books to get a feel of what it is to be there on a day-to-day basis.
Thank you. Fernando has a question. I would like to know if at the end of the day, CFM strategies are totally based on the analysis of the financial data by the machines, or is this, or strategies combined with economic views?
Oh, but it's strategies combined with economic views, but there's always, I mean, you can have a strategy that works in the past and you can say, oh, it works in the past, but it will not work in the future for this and this reason. I mean, there's always the decision to put, as they said, the strategy in production. And it's, of course, based on data, etc. It has to make sense, I think. So where we're losing sight a little bit of that, I mean, where quant managers can lose sight a little bit of that is when they put in place, machine learning strategies, because then they don't quite know exactly what works and what doesn't, and that's popular in the profession these days. But in general, there's always an economic reason for which, because.
But I think so the question is more whether we do any discretionary trading, and the short answer is no.
The answer is no.
All our strategies are quantitative and are based on quantitative analysis, employing all the possible tools of econometrics, etc. But they are all back tested.
But there's always
prerequisite for a strategy to go in production. And there's no discretionary decision taking.
There's no Bill Ackman decision to bet against the corporate bond market for several billions of dollars. No, so that is not done at CFM, at least not to my knowledge. Maybe
no, it's not.
I don't think so.
Good. Tesshi has another question. If economic macro variables come out less frequently, quarterly versus daily, how can quant hedge funds react quickly and capture rotations like the vaccine trade of this week?
Go ahead. No, I mean, there are variables that you get at a higher frequency than quarterly. I think where there is a lot of meat, probably more than what is currently done at CFM or elsewhere, is everything that's related to text analysis, because there you have like a continuous flow of text, on markets, and always people chatting and lots of chatter. That's super high frequency, like it's at the second really. So there is a lot of meat, and then there are lots of other indicators that come in at high frequency. Yes, of course. Mm-hmm. Yes, Adam.
No, I just wanted to add that what we see is that markets, they exhibit patterns at different time scales. So you might want to have strategies which are relatively slow, would look at the fundamentals, and then they won't be able to capture very short-term developments in the market. But you cover this side, this part, by having strategies that are simply faster and that look at variables that come out with much higher frequency. And typically it makes sense to kind of overlay strategies of different frequency, because it gives you more diversification, and you're capturing, you're riding the short-term trend, but you also look at the fundamentals at longer time scales, and that's very useful.
Good. We have another question. Sorry, Leonardo, go ahead.
Yeah. So, I was just wondering, why do we see a lot of asset managers with an MBA background rather than economists, or more people who have the technical ability to get in that area, right? So I know Professor Thesmer, he said he mentioned Bill Ackman, right? And I know he's we often see a lot of asset managers who just have an MBA background, right? Sorry, you go ahead. Yeah.
I mean, you have the two populations really, so that's what makes things interesting. You have like the investor, so that's what Adam said at the very beginning of the presentation. The quants are a segment of the investing world, but it's not the only one. And then you have like more qualitative managers that base their investment decisions on intuitions. They're trying to capture, in a sense, the non-stationarities in the world. So a little bit the vaccine rotation that happened that Tess mentioned. I mean, qualitative managers try to anticipate on those trends, etc., for which it's hard to backtest in a sense. So everybody, so in the ecosystem of finance, basically, there's room for everybody. I think that's kind of the idea. I mean, there's no one has a definitive edge over the other, simply because quants have to be quants have to have some history to backtest their strategy, while qualitative managers are able to anticipate trends, but they have no I mean, they're much less disciplined. So I mean, yes. So everybody will coexist. Yes.
All right, thank you.
And I guess if I may chip in, is that that's why asset managers and hedge funds, they like to hire people from different backgrounds, like from different walks of life, because different people bring different way of thinking to the table, and this is this is typically very useful when you're having discussions about an investment strategy, because you have different points of view.
Thank you.
Thank you, Leonardo, for your question. We have another question from Khosra. What do you think is the likelihood of researchers actually being able to find some usable theory of markets? I hear someone laughing, I think it's David. Are new developments in asset management more likely to come from more advanced methods of finding patterns in data via statistics than a new theory?
I mean, the theory of market is, so that's exactly what Adam was saying at the end when he was discussing, questions that are interesting for managers and questions that are interesting for economists. They are not always the same. So a theory of market, I mean, I don't think managers try to have a theory of market. I mean, it's always useful to have a framework, but it's kind of a theory of market is a bit too big.
I would love to have a unified theory for all markets, but
everybody but as intellectuals, not as practitioners of finance.
I've learned how to live without it.
Yeah, but it's like a theory for politics, or it's hard to find theories in general. In particular, in social science, it's true that some of the developments that we've seen at the beginning of the week, we were discussing it with Adam yesterday, I think. They're a bit of a challenge to the efficient market theory. Whenever United Airlines goes up by 30% in a single day because we discover a vaccine that we would have discovered anyway. How is it compatible with market efficiency? It's not quite clear. So we're always getting those questions that we're wondering about, but they are not really directly related to the day-to-day business of an asset manager. Then there's the second part of the question, which is a bit different, which is on are new developments in asset management more likely to come from more advanced method in finding patterns in data via statistics than a new theory. So it's very empirical, quant investment. So in a sense, you have a broad theory in mind. So you think, I don't know, that by watching the number of cars on a parking lot, you can predict the consumption. Parking lots of supermarkets, you can predict consumptions better than the rest of the market, and therefore predict, let's say, Amazon stock price, let's say something like that. That's an economic theory, but it's not a formal model of the economy. It's kind of a broad economic mechanism. And then you're looking at whether the signal actually does predict returns. So in a sense, the answer is combining data, finding pattern, but those patterns have to be motivated, I think, at least when you're talking about slow moving trades, like the part of trades that Adam was mentioning, where economists would be more useful. Then you can apply more blind machine learning techniques to try to figure out the very high frequency patterns of the data. But even there's economists in a sense. It's the dynamics of the order books, it's orders that are put there. It will generate patterns in prices, etc. So even there's a little bit of economics, but it's never like a hardcore theory with lots of Greek letters. Sure.
And if I may jump in, sorry again. then there is actually the I would say that well the likelihood I don't know, but the statistics definitely, the statistical approach is very useful, and there's even a strand of literature that tries that became quite fashionable over the past decades to disprove the efficient market hypothesis by actually proposing strategies that beat the market over long term, the so-called academic equity factors, for example. So, yes, the statistics can help to attack certain beliefs and certain theories that are, that economic theories, and may help drive the new developments. Yeah.
It's a good point, actually. The idea that it's what economists do in a sense. They have theories, they reject them with data, etc. And so this data work actually turns out to be useful in asset management. Yes, exactly. That's a bit the pharma French agenda in a sense.
Exactly, and it's always it's a cool way of approaching things, because you're on one hand your research suggests that maybe, say, efficient market hypothesis is invalid, but you're proposing your research via through developing an investment strategies that you show that beats the market and is capitalizing on a certain, say, behavioral pattern that goes against the efficient market hypothesis. So somehow
exactly.
the quant,
so in fact
it
is useful. So in fact it is useful to look for a grand theory of markets, because by rejecting it you find stuff that turns out to be practically useful.
So in a way that the quant finance kind of transpired to say economics as a as a way of pushing floating at least new ideas.
I can't believe we're almost out of time. We still have 3 questions to go. The first question is from Yodam. Is there place for financial economists without a PhD in quant funds? If so, how are they able to support the ongoing effort of the fund?
I think they have a bit of a less of a strong training in asking. So what PhD economists have compared to non-PhD economists is that they have spent a few years trying to think by themselves about a lot of questions. Like they've written a very big, master thesis in a sense. And so this habit of asking yourself questions gives you an edge when you're working with data and trying to think about new strategies in a given space, etc. It gives you a little bit more autonomy in research, but that's not the only place where economists can be useful, So economists can assist researchers. So there, having a PhD is probably better. It's, I think, even like if you want to be in research for a quant fund, if you don't have a PhD, I think it's almost impossible. But economists can also help with clients, because clients are asking all the time economic questions. Oh, suddenly your machine doesn't work. So they can ask a simple question. So to be Lachman is going to be easy. Oh, you made a bet, it didn't work out. Okay, so there's no question asked. Okay, so we withdraw our funds or not, but that's it. For a quant, it's always, those economic questions are always coming up. Oh, you were betting on that class of strategies and it turned out not to work, or it turned out to work like dramatically well. Why is that? And there, that's kind of where economists can help a lot to kind of formulate a doctrine. Why do we have that strategy in the first place? Why didn't it work this time versus et cetera, et cetera? So kind of a narrative, to build a narrative. That's critical sometimes with clients, yes. Just to convince them that what you're doing, you know what you're doing in a sense.
Yeah. Adam?
No, I was just smiling.
Right. Okay, so we have
Adam is snarky.
We have 2 social media questions before we wrap up. The first social media question: some in the financial community say that ML has become a research tool. Can you speak about if and how you incorporate ML into your research process?
I think I've already answered this question in part, but I can answer it again. So it's in the nature of financial data that there is a lot of noise and not that much signal. So you have to be very careful when you employ the machine learning techniques, because it's easy to find spurious relationships. So, but having said that, yes, careful and prudent application of machine learning techniques can be very beneficial and actually can help you to identify patterns you might not have found otherwise. So it is, ML techniques are commonplace on the quant side of the business right now. And yes, we are employing machine learning techniques, but we're always very careful about, making sure that we understand what the machine is really doing.
Excellent. David, do you want to add to that, or can I just move on to the next question?
What I want to add is that the interpretability of machine learning is actually ongoing. I mean, it's ongoing research by machine learning specialists. I mean, it's not always easy to interpret, but it's really, that's really the graal. Everybody's looking for that, and I'm sure we're going to make progress. There's already some progress in that direction, but definitely important to be able to understand what we're doing, yes.
Nice. So I'm wondering if this second social media question is an extension of the first. Well, anyways, the question is, do you always start from some kind of theory and carefully design your features? Or on the other hand, you feed your models with a huge number of features and exploit ML to make sense of the data?
I
think the first is dominant still, no?
Exactly. And I was smiling again because, that's often what happens to me when I speak to David. David reads so many academic articles, and whenever we speak, he has some, he's seen another article and there's a new idea around, and then we start discussing and see whether it's kind of related to the ideas that we already have in our portfolio, or it's something genuinely new that we should be looking at. And so, the short answer is yes, we like to have a prior. We like to, we start with a prior, and then we work ourselves around that.
It's really the way it works, both in academic research and in applied research. You start with a prior, and very often you end up very far from the prior, but it's kind of it's a discussion between the data and the prior, and you update the prior. I mean, it's very rare that the prior is really what you, but I mean, that's the way it works for any kind of research.
Well, it is 12:01. I can't believe the time went by that quickly. I wanted, on behalf of the Department of Economics and the Program for Economic Research, thank you both for agreeing to meet with our students. They are eagerly marching towards graduation, certainly, but marching towards the job market. So this conversation has been really very helpful, and we very much appreciate your insights. Thank you all again for participating in the PER virtual live series. The discussion continues online at econ.columbia.edu/PER and on Twitter and Facebook and LinkedIn. Join us on Wednesday, December 2nd for another discussion on the changing role of economists globally. Our business and finance thought leaders will be Lee Yun Jian, partner of at the Emigrant Bank Fine Arts Program, and also Drew Watson, Senior Vice President at Art Services at the Bank of America, and Cynthia Sachs from Athena Art Finance. On December 16th, we're going to have Mika Rokanen from Amazon, and also some other amazing guests. So please follow us on social media and watch out for our emails. I want to thank you all again. Stay safe, and we will talk to you soon. Thank you, especially David and Adam.
Thank you all.
Thank you. Thank you. Thanks the students for sharing their questions. It was really, really interesting.
Thank you. Bye-bye.